The next problem I wanted to walk through with you is exercise 11-4A. And this deals with numbers of shares and book value per share. The book doesn't do a great job of talking about book value per share, so I wanted to go through this with you. I think it'll help you. So ENSCO Enterprises has 225,000 shares authorized. That's the amount of shares that the board of directors has said they're allowed to issue without having to come back and ask for more permission. They have 150,000 shares that have been issued, so they've actually given those shares to stockholders in return for cash or assets. And they have 30,000 shares of treasury stock that they have purchased back. So that's 30,000 of the 150 has been bought back and is sitting in a desk drawer in the company. So it's not outstanding any longer, meaning it's not owned by shareholders any longer. At this point, EEI has 780,000 of assets, 180 of liabilities, and 360 of common stock, and 240 of retained earnings. They have a market value of $7 per share. So this problem's asking you a couple of different questions here. So the first thing, A, the number of shares of stock that is outstanding. Outstanding means owned by shareholders. Let's take a look at that math here. So I'm going to take the amount of shares that are issued, 150,000, and subtract the treasury shares, 30. So that gives me 120,000 shares outstanding for this company. Next, they want you to determine the book value per share. What that means is it's the equity of the company divided by the outstanding shares. That will give us a book value per share. Equity is equal to net assets, assets minus liabilities. So it's a way of looking at the net asset value per share of stock. So in this case, we've got 360,000 plus 240, that's common stock plus retained earnings, divided by 120,000 shares. So I get 600,000 divided by 120, or $5 per share. Next, they ask for a rational explanation for the difference between the book value per share and the market value. Well, you should put this in your own words, of course, but the book value represents the net cost of the assets, what we paid for them, less the liabilities per share. The market value of the company, the market price of the share, is based on what the current value of those assets are. So maybe they've become worth more money or that sort of case. And it also takes into account future earnings. So an expectation of the company growing and becoming more profitable will result in a higher share price. So that's the difference between a market price and a book value per share. I hope you found that helpful. I'll scan and put this on Moodle as well. Thank you.